The Trade is brought to you by ACY Securities, Tim Cahill's official FX and CFD trading partner.
Hello and welcome to The Trade. Great to be here with you. I'm Nadine Blaney. Well, before we get to the charts, let's take a quick look at what traders are watching. And the finance ministers of Japan and South Korea have expressed serious concerns about the recent depreciation of their local currencies. South Korea's finance ministry said that in a statement released just today. Also, we are watching Israeli tanks pushing back into northern Gaza, but oil prices are relatively flat as those economic headwinds counter some of that Mideast supply concern. Meanwhile, as we watch Asian markets come to life, the MSCI Asia ex-Japan Index closed at a 2-month low. We are expecting Chinese equity markets to close just mildly negative, down by about 0.1% for China's CSI 300 at 3,509. Just looking around the region as well, already we've got the Nikkei down by about 0.6%. So let's get to the charts that matter today. And Peter Pan from ACY Securities joins me now. Peter, a pleasure to see you there today. Look, it's hard to look past gold in this environment with rates higher for longer and some of the big investment houses, increasing their expectations for the price this year.
Yeah. So in the last 2 months, the gold price has risen like 20%. However, let me make my opinion very clear. I don't think there is more opportunity to long gold in the last like 1 month, 2 months, or half year. The reason behind that is because the fundamental value of gold can't support that high price. Let's say that from demand side, many people will think central banks is keep buying gold. Yes, that's right. However, they are slowing the speed. Let's say like China, like Turkey and Poland in the last 3 months, they are not increasing buying the purchasing speed. Actually, they are slowing those speed. Especially China, the purchasing amount in March is like only half the number of July, like December last year. So that can support the demand, and also the globe the gold ETFs all over the world are reducing their position in gold. So demand side can support gold price that high. And on the other side, when we talk about fundamental value, we're mainly focusing on the real interest rate for like 10-year US bond. However, recently, especially for the last several months, the real interest rate is not dropping but rising, has already risen to 2.2%, which is not very close, but at an upside trend to the previous high, which occurred in last year, November. And you need to know that in last year, November, the gold price is only like 17 to 1800, which is like 40% lower than current gold price. So from the fundamental side, we don't think the gold can reach to that high. And the only reason gold is keep rising, especially for the last 2 months, is the war. Is between Russia and Ukraine, is between Hamas and Israel. And mainly, most importantly, is that more and more countries is getting involved. We can see like France, Poland, and also most importantly, Iran has been involved in those conflicts. However, when we see like last weekend, Iran has do some most attack, right? However, 99% of the attack has been blocked. There is no much damage to Israel. Only like the influence is limited, especially when we see the gold price after the Iran attack. The gold price doesn't like rise very fast. So I think current situation is just like 2020 22 when the Russia and Ukraine war started, the gold price started to going downside for nearly one year and not coming back only after 1 year. So I think the expectation for like world war has already priced in to the gold price and make the gold to reach to 2,400. So it has already priced in the expectation. So because I don't think Iran and Israel will get into war, there will be still continuously conflict there, but there will not be war between these two parties. So I think the gold price has already reached to its high. Maybe it will get more higher, like 25,000, 2,500. However, that's it. So in longer term, I think the gold price will keep going down. However, from technical side, I do think if you want to short gold, because there is a lot of uncertainty in current situation, I think you need to short it only after it breaks through 2,300. And after that, you can short gold even to 2,000 or below 2,000.
Right, so there you go. You could even short it, but you need to follow that guide that has been spelled out by the charts. Thanks for that, Peter. Really interesting when all this enthusiasm is happening around gold. So there's some food for thought. Just onto another chart. And with US dollar strength, well, it's going to be an interesting one to watch when it comes to the euro cross, correct? Because if we do have the ECB looking to cut, which it apparently is looking to do so, we heard that confirmed through the overnight period. If the euro goes first, what happens with it?
Yeah. Okay. So recently, the expectation for this year to cut the interest rate has reduced, which has not weirdly, which is not influenced the gold price or the oil price, but it does influence some asset class, include which most obviously is the US dollar. So we can see from last week, the US CPI is higher than expected. And that started to rise the US dollar and lower the euro. So that's the reason why the euro dollar has break through 1.07, which is a very strong support line. And I think it will keep going down, especially yesterday, as you said, the ECB is still seeking to cut the interest rate this year. And the expectation has already priced in for like 3 to 4 cuts. But I think it will be more because the euro economy does do worse than United States. And at the same time, we can see the federal governor Powell also changed his mind. He said that the inflation is still too high, and the high interest rate may be kept like longer. So that's a huge difference between euro and United States. So in ECB they want to cut, and for federal they maybe want to keep the interest rate higher for a longer time. That difference will make euro dollar very strong short force or keep going down. So for euro dollar, I think it will keep that trend for downside. There is two opportunities or two technical trading strategy. The first one is to short it after it retraces. The resistance line will be 1.68, 1.068 to 1.07. However, I think there will be like more stronger like sentiment to push it down. Maybe it won't retrace. So after it breaks through 1.06, it will also have a short position, short opportunity there. And the strongest supporting line is 1.05 to 1.045. So keep shorting it until there is some new economy data for United States coming out, but it needs to be bad data. Yeah.
Okay, all right. Well, we'll keep an eye on that chart as well. What about the S&P 500? Because we've heard so much about the lack of breadth. We have earnings season upon us, and of course, it's against the backdrop of interest rate rhetoric. So, where are we looking in terms of momentum for the S&P 500?
Okay, so for the FP 500, many people think it is because of the reporting season. However, I checked the recent reporting performance, and like more than half of those companies performs better than expected. The worst sector performed is the financial sector. However, when we say those like Goldman Sachs and JP Morgan and like Bank of America, yes, they perform better than expected. There is good news, there is bad news. Like for the Bank of America, the damage from those commercial property is higher than expected. However, the performance, like the income, the profit is still higher than expected. So it is not that bad news for SP 500 for the US stock market. The reason why SP 500 drop, there is two parts. The first part is exactly same as euro dollar. It's because of the US CPI is higher than expected, and at the same time it raised the real interest rate. It raised the like 2 years, 30 years US bond yield. That's the main reason which gave pressure to US stock market, and at the same time, which supports SP 500 to rise continuously for 5 months is the AI sector. And recently, the AI sector doesn't perform very strong. There is some kind of retrace. So I think there is pressure on SP 500 because of the interest rate. However, AI sector has also facing their supporting season. Let's say this week, we have Taiwan Semiconductor. Although it's a Taiwan stock, however, recently the AI sector is mainly based on the supply side. So the demand side is keep rising. However, the supply side is limited, especially when Taiwan has faced like the biggest earthquake in 25 years. So people are keep focusing on whether Taiwan Semiconductor can like recover their production before the earthquake. So tomorrow there will be a financial report for Taiwan Semiconductor, and it will give support, maybe like pressure to the entire AI sector, especially for the semiconductor like producing sector in United States stock market. So that's the reason why I think the stock market SP 500 will bounce back, and the most dangerous thing we will see will be next month when like Nvidia, Microsoft, and those other IT companies release their financial report, and after that it may break through 5,000. When it breaks through, it means the AI bubble started to crash.
Oh, okay. Well, that is forbearing. All right, Peter, thank you so much for your analysis of those key charts, ones we're watching closely. Have a good day. That does it for this episode of The Trade. Be sure to join us tomorrow.
The Trade is brought to you by ACY Securities. Tim Cahill's official FX and CFD trading partner.